Thank you, Chair Yellen. Good to see you today. I had a question, maybe it's a bit to follow up on Mr. Ginta's point about the unprecedented consolidation that we've seen in community financial institutions, where there are fewer and fewer of them, and these smaller institutions have fewer assets over which to spread their ever-growing compliance costs. So they often seek those economies then through mergers, and that's what leads to this conundrum now of a situation where we've got fewer banks today than we did during the Great Depression. And are you worried about the consequences of consolidation for communities and for our economies, and eventually for over-leverage as you end up with just a few big institutions having so much?
Well, I do think it's essential that we have a vibrant set of community banks serving America's communities. They play a very special role in our financial system, and it's important that they remain healthy. Reducing regulatory burden is important. It is something that we will seek to foster using every available tool that we have. Community banks face an challenging environment, though, for reasons that go beyond regulation. The low level of interest rates and flat yield curve and slow pace of growth in the economy are also factors that are making it difficult for them to thrive. But they are tremendously important at the role they play for American households and businesses, and we will certainly do everything that we can to relieve burdens on them.
Yes, and some of that's driven by monetary policy, some of that's driven by fiscal policy. So that's another way in which they're adversely impacted by decisions made in Washington. So it seems to me at the heart of the consolidation, as you say, are these, well, it's really an avalanche of rules that have forced small institutions to hire extra staff. That's the situation. The economies of scale for them that